Hi, good morning, everybody, and welcome to my stop today at the Credit Festival Lending Summit, looking at the revolving credit economy and what it means for your borrowers and what it means for us today as an industry. My aim in the next 20 or so minutes is to share with you those key trends at that macro level which are most relevant to our day-to-day jobs, but then take that one step further and really take you into the granular details that allow you to take the actions and pull forward the insights which can help you better understand the borrower and the economy. So there's a packed slide deck and I'll get started straight away. Before we dive into some of the trends which are somewhat disappointing, I do want to take a step back and talk about one of the success stories during the pandemic, and that's the retail sales. The retail sales number has bounced back stronger than where it was in February of this year. And as an industry, this has a big implication for us. There are many different credit products. As Marcel's already spoken about in his opening remarks, we'll have sessions which dive into some of the alternative lending, some of the secured lending and mortgages. But what's been happening with retail sales can clearly be seen in retail finance and revolving credit. And what we've seen in both of these product items is strong growth for many of those retailers, many of those credit lenders, growth that they've never seen before as well. And that is being explained by this move online, this move, as we're going to see in a moment, of consumers really starting to purchase more and more through e-commerce. And whilst retail sales have bounced back, they're the strongest they were, as I've said, stronger than even when they were in February. We can see the role online sales have played for that. And again, point of credit, being able to actually take credit when you're buying that item online has seen a boom over the recent past. What I want to do is just take a moment and unpack the chart that you're looking at now. So here you can see a general trend, and this is the percentage of retail sales that online shopping is making up. Over the last decade, it's trended up, starting way below 10% and ending up just below 20% over the last 12 years or so. So a doubling over a 10-year period. With the onset of lockdown, and we're going to get into what that means on a sectoral and industrial view in a moment, but one of the impacts of not being able to go down to the local high street, to go into those non-essential retailers, for example, saw a direct shift of that spending onto these online platforms. And as that slide shows you, you can see in that last 6 months or so, we've seen retail sales once again increase by the same amount. It took nearly 10 years for that flow through to come to in e-commerce. So as we move forward and as we move on to the next few slides, I am going to take a sense check, rein us back in terms of our, shall we say, positivity, unfortunately, start to look back at what is a UK economy that is in various types of lockdown. We've seen our counterparts in Scotland, the Central Belt, still very much under some restrictions. And whilst the Welsh firebreak is over, there are still restrictions in big parts of Wales. And again, in England, we are still in a national lockdown 2.0. So my aim, like I mentioned, is to talk to you around the economics, which is actually most pivotal for us as credit market practitioners. Which parts of the economy can I give you insight on to help you better understand your borrowers, to help you better understand your commercial borrowers as well? And the first thing to know is, how can we provide you a more forward-looking view of growth? Many of us would have seen the press releases last week where we saw the ONS confirm that the UK economy had seen record levels of growth coming into the third quarter of this year. In fact, growth, whilst it did bounce back quite strongly, as an economy, we are still somewhat 10% lower than where we were in 2019. So at the trough of this crisis, the UK economy had lost over a fifth of its production value, even with a strong bounce back with Eat Out to help out. And as the lockdown came to an end in the third quarter of this year, we are still 10% lower than where we started. So a shock that has not gone away, a shock that unfortunately, if we look towards that green line, which is a weighted survey of businesses, is suggesting, even ahead of the lockdown announcement, which we saw earlier this month, even ahead of that extension in furlough, which we saw at the end of October, the economy was slowing down. Consumers were feeling less confident. And what we are suggesting now, unfortunately, is the UK economy is going to end up back in negative territory. So we are going to see a negative Q4 number come through. And this matters for us because, again, taking a step back, whilst GDP is not the most relevant factor for credit markets, unemployment, profitability, pay, all of these variables are heavily correlated with GDP. And so as GDP is weaker, you expect pay to be weaker, you expect incomes to be weaker. And most importantly for us, as I'll show you, you will expect unemployment to increase. So let's move on to the next slide. And what I'll show you there is the ability for us to actually turn back to the consumer. We need to understand what the UK economy from a consumption perspective is actually doing. And that's because over 70% of everything we do in this country is to do with consumer spending. So you have to understand consumer spending in order to then understand what's going to happen for demand for credit. And the first thing that is being called out here is consumer confidence has once again declined as we moved into October. Another reason why the economy is going to contract at the end of this year. And like I've mentioned already, where we are is in a situation where as the consumer becomes weaker, the economy will weaken and we will see further increases in unemployment going forward. I set myself the challenge of getting through my slide deck in the time allotted, but also to impart the insight that is within it. And in order to do so, I'm going to break away from that macroeconomic picture for just a moment. We're going to start to turn back to the model that we've built within Experian to look at sectors. Now, what do we mean by that? Well, COVID-19 has led to the first ever lockdown. It's not the first ever recession, but it is the first ever lockdown initiated recession. And that's important because for the first time, there are clear winners and losers in terms of those parts of the economy which are surviving, some would say close to thriving during the lockdown period. We can take food spend, for example, supermarkets, etc. have had a very good period in the last 6 months or so. And there are very clear losers. Unfortunately, as we all know, with the second lockdown in England, all of the accommodation and food services, your hospitality, your restaurants have closed down once again. And what that means is, one, you really want to understand the economy, you have to understand the sectors which are being hit. And the accommodation and food services sector is a key one, which I'm going to come back to again and again in the next 10 minutes or so, to help you understand how you can take the macroeconomics, take it down to the sectors, and actually take it down to your portfolio, which I'll show you in a moment. Headline from this slide is that the accommodation and food services industry has the lowest percentage of actively trading businesses. 1 in 4 accommodation and food services businesses has actually said they have closed down. Now, this is important for 2 reasons. We are starting to hear the positivity around a vaccine. We are starting to see the early signs of us getting back to a normal economy, if you will, with the creator of the Pfizer vaccine just yesterday remarking that he would expect the global economy to get back to some kind of normal in the winter of 2021. And so what we've tracked on this slide for you is our view of when the various different sectors are going to get back to pre-COVID life, pre-COVID levels of output. When can they actually make up all of that lost profitability that they've seen over the last 6 months or so? The first call out is there are various different times, and you can see all of the sectors that we've tracked onto this. The reason for calling this out is from a commercial lending perspective. Again, whilst GDP may not be the most important economic variable that feeds into your modeling, profitability, the ability for these sectors to repay their debts definitely is. And once again, that is heavily correlated with overall GDP growth. And so as we continue to move through the slide deck, I'm now going to show you how these sectors can be mapped back to the regions and local areas to help you take further action in terms of understanding your portfolio. So this slide now is really helping us to understand which parts of the UK in terms of that regional level, geographical level, are going to be the hardest hit from COVID-19 and which are going to bounce back the fastest. And as you can see from here, the ability for us to understand where those sectors are. So for example, the southwest of this country has a lot of its jobs relying upon tourism. So the accommodation and food services sector makes up a bigger proportion of overall jobs in the southwest, and hence you can see that part of the country, one of the parts of the country that fared the best over the last decade, is actually very much well below the UK average of just 11.5%, nearly contracting by 15% in our forecasts. Again, the way I would explain and how we would use this is be in a position to track these back to those very high macroeconomic variables around unemployment and income shocks. So let's move on. And I am going to pick up the pace now because over the next few slides, we're going to dive into what I believe is the biggest and most important indicator from a credit market perspective from the economy. But before we get into how unemployment is actually hitting the credit markets, I'm just going to share with you our granular insights. I showed you which regions are most impacted by COVID, but actually our data goes much more granular than that. We're able to show you which towns are most hit hard by COVID-19. And how have we done this? We've looked at those sectors such as accommodation and food services, the recreation sector, the leisure sector, those sectors which have seen the biggest hit to their output since the onset of COVID-19. We've then mapped back where these sectors actually operate in terms of jobs back into the UK and Great Britain map here, as you can see. And the way that we then allow this action to be, insight to be actioned, if you will, is the ability for you to look back at your portfolio, understand where your customers, your borrowers actually live in these areas, and how many of your borrowers are concentrated in, for example, that southwest region. How many of your borrowers are in Scotland? How many of your borrowers are in Edinburgh versus Glasgow versus Aberdeen? That granularity then tells you a completely different picture from the UK macroeconomic level, that UK regional level I showed you. Actually being able to get down to this town view is crucial. And as we move on to the next slide, we're now concentrate once again onto those sector pressures. Where are we in terms of understanding that impact of recreation, accommodation, and food services? So we've almost don't care at this stage about any other sector. We just want to see the percentage of recreation and accommodation and food versus the rest of the economy in these local areas. So we're not saying that they get their most, we're not saying that they get the most in value terms from this part of their services and sector mix, but we are saying this is the most important as a percentage. So again, now starting to run these insights through our models, you're able to see those parts of the country, if a lockdown was to continue, or if in the new year we were to see another lockdown and recreation and accommodation and food was once again hit, then you will see these parts of the country starting to lag behind the UK once again. Again, both in these boxes, you can see those areas that are most exposed, and you can see those areas that are least exposed to this recreation, food and accommodation sectors. Now, up until this point, I've only spoken about GDP or gross value added, which is GDP at a more local level. This has all been about output. And I've asked you to then correlate that through to the impacts of unemployment, to the impacts of income, to the impacts of wages and salaries. I'm now going to take us one step further. I'm going to start to talk to you in terms of unemployment and actually show you how we translate all of this granular insight into unemployment curves, into bespoke unemployment risk, right down to an account level, which you can actually start to see on your own portfolio. But before we dive into that, I again just want to bring you up to date with the latest ONS data. The ONS estimates that unemployment now is at 4.8%. Here at Experian, we believe that the real unemployment rate actually sits closer to 7%. The reason why we deviate from the official number is because COVID-19 has made it really difficult for the ONS to truly capture what we believe as credit market practitioners is the definition of unemployment. So the ONS requires somebody who is classifying themselves as unemployed to be actively seeking work. We know that many people have been turned away or turned off from the labor market, if you will, because of COVID-19 and the pandemic. Whilst they've been made redundant from their sandwich shop job, for example, they are not actively looking for a job right now because the skills that they have, they feel that industry is under a lot of pressure. Therefore, they are going to wait potentially until there's a vaccine, until there's some kind of resolution. So if somebody has been made redundant and they are not actively looking for work, they do not get classed as unemployed. The second biggest category this time around in this crisis are those people who are temporarily away from work. These are people who are not captured by furlough, who are not captured by any of the government schemes. Yet when the ONS asks them, are you in employment? They say that they are temporarily away from a job. In our view as credit market practitioners, we believe this very group, the fact that they have suffered an income shock, they are not covered by any of the government schemes, they should be being classed as unemployed. It's when you bring these two numbers together, you end up with an unemployment rate much closer to 7. So we believe as lenders, as people actively going out and lending money, we should be using the unemployment rate, which is most sensitive to the credit markets, rather than an academic definition, which has been put together to allow economies to compare and contrast unemployment rates globally. And that's shown up in this chart here. Again, that temporarily away from work number, which I spoke about a minute ago, just looking at the orders of magnitude, you can see here during the last crisis, we only saw 300,000, 3 million people or so temporarily away from work. We saw that pick up to nearly 9 million, 3 times as much. And even in the latest numbers, that whilst that has come down, it remains elevated well above, orders of magnitude above what we saw last time around. So again, backing up our view of the world, that the unemployment rate is actually much higher than what is being reported by the ONS. Again, the same way that I was able to help build us away from just that macroeconomic GDP level, look at which regions were impacted, look at which sectors were impacted. It's the same view we have on unemployment. We really have to get into the details. And a headline that you no doubt have seen across all the economic commentaries is that younger people are being hardest hit by this recession. They are being hardest hit in terms of unemployment, and that number comes out here. You can see that over 12% of all of those people that have been made unemployed are in the 18 to 24 range, and they sit comfortably at the higher end of unemployment by age. As we move on to the next slide, I'm just going to take 5 minutes or so, the remaining 5 minutes of my time, to get into the detail around how we can move from the macroeconomics into those tailored unemployment curves. And so this slide is for illustrative purposes. It pulls together what I've shown you, our view of the world in these regional blocks, understanding which parts of the country are most exposed to COVID. We then move over to our financial strategy segments, if you will. This is our view of the UK population in a way to try and understand which parts of the UK economy, the demographics are most impacted by COVID-19. As I've already shown you, younger people typically are hardest hit by the pandemic and the associated economic costs. So if we know where your customer lives, where your borrower lives, and we know which demographic they fit into, we are able to actually pull these two sources together and start to talk to you in unemployment curves that are tailored to your own portfolio. So how do we do that? Well, for example, we go through all of your accounts. We understand where those concentrations are across the country. We then understand and estimate which sectors, therefore, most people are going to be working in. For example, a lot of the accounts in Hounslow are going to be working in Heathrow, and the aviation sector is going to be very hard hit. We then look at the demographics. If you're younger, you're more likely to be working in the services sector, and therefore, again, you're more likely to be hit in terms of unemployment. When you pull together the two forces of where your customer is, who your customer is, and pull those together, you actually get a tailored unemployment view. So you're no longer talking about the UK averages. You're in a position now to really get down to that granular view and understand what's happening. And the next slide shows you just how granular we can get. We are in a position to actually get down to an account level, explain to you through our red, amber, green rating, whether or not that account is more likely to be made unemployed versus the UK average. If they're in that red category, then the likelihood of them being unemployed is very high. Amber, it's at the UK average. Green is better than the UK average. So again, that mix of our data sources allows us to really dive deeper and understand what's happening from an unemployment perspective. Again, unemployment has been the key correlator in all past crises to the credit markets. Unemployment is going to pick up into 2021. Unemployment is going to increase going into 2021, but it is not going to be the same for all lenders. You really need to be understanding your exposure to unemployment in order to take the correct strategic decisions. As we move through the last part of my slide deck, what we brought up here is an economy that we've spoken about is impacting younger people, is impacting different parts of the country. Turning back to the credit markets, we are already seeing that lenders in the mortgage market have actually increased interest rates. At the same time, the Bank of England is talking about negative interest rates. For the Bank of England, and from their intelligence, they believe some of this is to do with market demand and the fact that some banks are actually being in a position to not being able to satisfy all of the demand in terms of applications, hence increasing prices. We would read that as actually the lending community still being very unsure of the future of the economy, and there are many reasons for that, such as Brexit. And because they are unsure of the future of the economy, they are increasing rates because they do not fully understand the risk of the borrower coming through their door. And so I mentioned Brexit, and again, we've carried out a lot of analysis to try and understand which parts of the sectoral mix are going to be hardest hit from a no-deal Brexit potentially. We all know that the deadline for talks keeps being extended. More deadlines have been missed than have been met. There is another crunch deadline later this week. If a no-deal Brexit was to happen, we have identified through our RAG ratings which sectors are going to be hardest hit. And what we've done here is overlaid the impacts from COVID, and you can start to see some interesting trends. Firstly, some of those sectors, such as food, drink, and tobacco, who had a very good COVID impact, are actually going to be hard hit by Brexit. On the other side, some sectors that have already been hit by COVID-19, such as wholesale, air, water, and transport, are going to see a second hit from Brexit. So as I've shown you before, let's map this back to parts of the country. And as you can see, the East Midlands, the Northwest, West Midlands, unfortunately, if we were to see a no-deal Brexit on top of the COVID shock, are parts of the country that are most exposed to those risks. And finally, my last slide, when we go that one level deeper, we go down to that granularity of those towns which are most exposed to the impacts of Brexit after having COVID. You are now in a position to see all those local areas once again, where if you have higher than the UK average concentration in accounts, for example, then you will see higher than average delinquencies being met should we have a no-deal Brexit. That's been a real whistle-stop tour of all of the content that I had prepared today. And with that, I'll hand back to Marcel for any Q&A.
Thanks, Mo. So with the window of payment deferrals extended and furlough extended, it seems that the government is flattening or trying to flatten the curve of the impact of unemployment and I guess business insolvencies as well. But with perhaps rising personal debt, do you think we might see a cliff edge next year when all this support expires?
So we can almost understand what's happened already from the delay in actually extending the furlough scheme. Anecdotal evidence has now been backed up by the latest labour market numbers, which saw redundancies at their highest level towards the beginning of September this year. So whilst we did see that extension in furlough come through, many employers have already taken the action. So no doubt the government measures will help flatten that unemployment curve, but a lot of the impacts that are going to come through into 2021, unfortunately, are already baked in. And so the actions on furlough, the actions on some of the business insolvencies that you've already spoken about, if you will, the damage has already been done by COVID-19, and we are going to see the government struggle to continue to, shall we say, extending these schemes. The government is waiting for, as all of us are, the vaccine. They are hoping to bridge the gap between a world without a vaccine, a world where lockdowns are still possible, to a world where we're back to some kind of normality. The extension of those schemes is trying to bridge that gap. If that's a bridge too far, we are going to see a cliff edge when these schemes are withdrawn. but it's very much in the government's ballpark to see how they can actually take that forward.
Okay, and while we wait to see the impact of when those various support schemes finally do end, I guess the other question is, how long can the government actually wait before raising tax substantially?
So we've already seen some information that's been released to the public in terms of consultations around capital gains tax and what that could look like. There has been quite open talk about increases in income tax, increases in other wealth taxes, etc. How long can the government wait is a very good question. I would take our read from the bond market. So in the previous crises, whenever the government has had to borrow more than is sustainable, you see the reaction come through, first and foremost, in the bond markets. Those investors, they ask for a bigger return on their money, a bigger risk premium, because they feel that the government borrowing at those levels is unsustainable. If we look across the UK gilt market and we look at those 10-year yields, they are unmoved. So right now, the government has still got some credibility left with the bond markets, and therefore the pressing need for them to actually get ahead and start increasing taxes is not there at this moment. We can almost take a complete read on when they will act if we keep an eye on those 10-year yield curves, because that is going to be the comes through in terms of making their debt levels sustainable.
Okay, thanks, Mo. I would love to ask a few more questions, but we do have to wrap up there. But thanks very much for joining us. Now, hopefully for you watching at home, that should have prompted some thinking among the audience of the type of economic recovery you're planning for or anticipating. And on that note, well, we're going to run a poll now, and this will be running until the end of the lunch break. Please now use the Slido tab, so that's to the right of your viewing portal, and look for the polls tab as part of that. And please answer this question. So which type of economic recovery are you planning for? V, W, a tick shape, or another recovery model? So please do take a look and give your answer, and we'll discuss the results of that poll just after lunch. For the next session, we have a panel of Chief Risk Officers from Cambridge Building Society and Think Money. Please stay tuned, as that's coming up in just a few moments.